One of the largest investments we will make is paying for our children to go to college. But statistics show parents routinely underestimate the cost, so saving now is a must. We're about to break it all down for you in this episode of Secrets of the 1%. Welcome to Secrets of the 1%. I'm Amelia Thomas, Managing Partner of Empire Capital Ventures. We help first-generation millionaires generate 9 figures in wealth through advanced tax planning and wealth management. This week, we are going to discuss investment options for those who are trying to save for college. Let's begin with 529 plans. With 529 plans, some states have a prepaid option where you can pay on a monthly or an annual basis that will be used for semesters in advance for college savings. Many states have actually discontinued this option as it turned into a giant disaster and a liability for many state governments during the 2008-2010 recession. With investment accounts, pension funds, general fund accounts declining to historic lows, many states were unable to honor their obligation to fund those semesters at the public school of the parent's choice. While some states still have this option, many of them shifted the investment risk back to the account holder, the parents. As a result, you are now able to open a 529 account and invest using the following methods. Many states have dedicated 529 plans. If you are seeking an option that will allow you to deduct up to a certain amount, contributions from your state tax return, you will need to use a specific state plan based on your state of residency. 529 plans that shift the investment risk back to the parent, the options for investments will be limited to mutual funds only in most cases. With mutual funds, I like to describe them as a container with hundreds of golf balls. Each golf ball represents one company. So one mutual fund may have 138 golf balls in its container. If one of the golf balls falls into the pond, guess what? You still have 137 others. It's the same premise when we are discussing investments. If 3 of those companies have a terrible year financially, you will have 135 other companies working in your portfolio. Make sense? For our next example, let's consider Vanguard's age-based funds that provide options for age-based funds with 3 risk tolerances: conservative, moderate, and aggressive. This is ideal for parents who want to conduct risk-related investing according to their child's age. For instance, if you establish an account when your kid is only 2 to 3 years old and the funds are for post-secondary education such as college, you have the opportunity to be more aggressive in investing for potential higher returns. As the child ages, the fund will automatically shift assets from equities to bond and cash reserves under all 3 options. It is also important to note that there are absolutely no guarantees. The custodian, which is you, the parent, is 100% liable for the investment performance of the account. Now let's assume that you want to diversify your dollars beyond age-based options. As of 2019, there are 20 other portfolio options for investing in a Vanguard 529. For illustration purposes only, let's look at 6 different sectors available. You have a money market account, you have U.S. bond portfolios, balanced portfolios, stock portfolios, international stock portfolios, and international bond portfolios. An important note, you do not have to invest 100% of the assets into a specific type of portfolio. You can decide to use a combination of portfolios to assist with diversification to reduce risk in the overall portfolio. It is also important to mention that the aforementioned portfolios do not only apply to 529 plans. They apply to mutual funds and exchange-traded funds in general. Next, let's discuss the different investment options for Coverdell, traditional, and Roth IRA accounts. What's important to note is that in order for you to be able to invest in stocks, bonds, mutual funds, etc., you will need to open a brokerage account with a brokerage firm that offers SIPC coverage. SIPC stands for Securities Investor Protection Corporation, and it is the equivalent of the FDIC coverage, but for investment firms. Coverage protects against the loss of cash and securities in the event that the investment firm has a liquidation or a bankruptcy event. The limits include up to $500,000, including up to $250,000 $100,000 in cash. It is duly as important to note that SIPC does not protect investors from a decline in market value or rogue advisors. It is only used in the event that the firm itself is liquidated. Your common, well-known investment firms are SIPC firms with the information permanently displayed on their websites and all of their advertisements. Once you find a firm, they can assist you with opening the right account and titling the account appropriately. From there, you will have your choice of how to invest the assets in the account. Coverdells, traditional, Roths, and UGMA, UTMAs are just titles. They have absolutely no bearing on how the funds are invested. With that being said, your common, well-known investment firms are SIPC firms with the information permanently displayed on their websites and all advertisements. Once you find a firm, they can assist with opening the right account with the right titling appropriately. From there, you will have your choice of how to invest the assets in the account. We have already discussed mutual funds, but let's dive deeper into a few other asset classes. Stocks, also known as equity. The primary reason why an investor would invest in stocks is for capital appreciation. Some stocks pay dividends, which will allow investors the opportunity to also generate income. Large cap companies that are very mature and tend to pay dividends. They also have a market capitalization over $10 billion. Mid-cap companies are companies that are probably not paying dividends and have higher growth potential than larger cap companies. These companies tend to have capitalization rates between $2 billion and $10 billion. Small cap are companies that are not paying dividends and their primary focus is capital appreciation. They are fast-growing companies with market capitalization of less than $2 billion. Bonds, also known as debt. The primary reason investors would invest in bonds is for the potential to have income of regular interest payments. It is also possible to make money on the purchase of bonds in the event the purchase took place during a declining interest rate environment. Here are a few different types of bonds. Treasury bonds. These are bonds that are issued by the United States Treasury Department. Government. These are bonds that are issued by federal agencies such as the Federal Housing Administration, the Small Business Administration. Municipal. These are bonds that are issued by local and state governments. For example, Alabama considered floating a bond for $900 million to build 3 new prisons. Or Cook County, Illinois may consider floating a bond to build a new elementary school. Corporate bonds. These are bonds that are issued by private corporations. With corporate bonds, the bond rating is very important. The bond rating is the corporation's version of their credit score. If the bonds are investment grade, meaning they have a good credit score, its grade will be a BBB or higher, or Baa3 or higher per the Standard & Poor's or Moody's guidelines respectively. If the bond rating is lower, it is considered a high-yield debt. This means that the corporation carries a higher risk, and as an investor, you should benefit from investing in higher-risk companies through higher yields or rates of return. Zero coupon bonds. These are bonds that are sold at a discount below par value. Par value is considered the face value of the bond, which usually trades at either $1,000 or $100. So if it's being sold at a discount, the bond is being sold for less than the par value. What's also important to note about zero coupon bonds is that they generate what's known as phantom income. Phantom income is when you are taxed on income that you did not physically receive and you will not receive until a later date. Be careful with phantom income, as it can place the investor in a higher tax bracket depending on the level of the income that was generated in that tax year. Commodities. Investors invest in commodities as alternatives to the stock market and the bond market. Commodities provide investors with more direct exposure to certain asset classes such as precious metals and minerals, natural resources, energy products, livestock, rice, cows, chicken, timber, you name it. Real estate. Investors tend to invest in real estate for passive income potential. There are numerous opportunities to invest in real estate to include, but not limited to, real estate investment trusts, also known as REITs, farms, residential, commercial, and even raw land. Exchange-traded funds. Exchange-traded funds are very similar to mutual funds in composition. They allow you to purchase a product with up to hundreds of companies participating to assist with reducing the overall risk in the portfolio. However, here are two of the most important distinctions between the two products. Number one, exchange-traded funds, also known as ETFs, are priced throughout the day, and mutual funds only trade once per day. For example, if the stock market started appreciating or declining very rapidly and you wanted to sell your position to either lock in gains or minimize your losses, you could do so with ETFs. With mutual funds, you would have to wait until the stock market closes before your trade will be executed. At this point, your gains or losses could be potentially higher or lower, depending on the continued fluctuations in the market. Number two, exchange-traded funds give the investor the ability to short sell, and mutual funds do not. Selling short is a type of option strategy, which we will discuss in detail later, that can assist the investor with hedging abilities and/or assist the investor with additional gambling. In this case, when an investor sells something short, they believe that the price is going to go down significantly. As a result, they bet against the security, and if the security does decline in value, they will profit the difference. For example, and for illustration purposes only, let's say that the investor wanted to short X, Y, and Z stock. They own 1,000 shares, and the stock is trading at $126.54. Due to the investor's own analysis, the investor believes that the share price is going to decline to at least $80 per share. In this situation, the investor sells his shares short and receives $126,540. The stock price did decline, but it didn't decline to $80. For example, and for illustration purposes only, let's say that the investor wanted to short XYZ stock. They own 1,000 shares, and the stock is trading at $126.54. Due to the investor's own analysis, the investor believes that the share price is going to decline to at least $80 per share. In this situation, the investor sells his shares short and receives $126,540. The stock price did decline, but it didn't decline to $80, and the investor noticed a bottom of $98.98. At this point, the investor purchases the shares back at $98.98 and pockets the difference per share of $27.56 or $27,560 to close out the position. Now, for example, let's say that the stock price did not decline in value, but instead it appreciated. In this case, the investor would have only received what was paid initially to them when they initiated the short sale, the $126.54 per share. In fact, it is not impossible to lose money when you take into account brokerage and trading fees. In this situation, the investor will miss out on capitalizing on any upside potential in appreciation unless the investor actually purchased the stock significantly below the exercise price of $126.54. Managed accounts. These are accounts where you pay an advisory fee on a quarterly basis to an investment firm, and they professionally manage the assets for the client. If you do not have a managed account, the investor is responsible for every investment decision in the brokerage account, including scheduling, rebalancing. Options. Options are hedging techniques used to minimize as much risk as possible in a transaction. Options can also be used as a method of taking larger bets. Option styles are numerous and requires monitoring, yet they can be very rewarding if implemented appropriately into a strategy. All of the above mentioned options can be used as investments for Coverdells, traditional Roths, UGMAs, and UTMA accounts. However, it is important to note that UGMA and UTMA accounts do require the custodian to invest according to the prudent man rule. The rule in essence states that the custodian must be prudent in the investment choices and act on behalf of the beneficiary at all times. The investment choices should not be reckless, and all choices should be supported with appropriate documentation and/or good reasoning. Last but certainly not least, with UTMAs, traditional and Roth IRAs, You can invest the assets into real property or other business ventures. You will need to consult with a qualified professional that will assist you with opening the appropriate self-directed accounts to accommodate those types of investments. I have only covered the very basics here, but you know I have more secrets to share, but you need to be an insider to find out. If you want to go deeper, head over to weeklywealthreport.com so you can have access to the rest of this pertinent information. Thanks for joining us. I'm Amelia Thomas, and see you next time for Secrets of the 1%.
The Convo, your home for conversations on Black entrepreneurship and wealth, available on your favorite platforms.